Good morning, everybody. Ed Yardeni here. It's Monday, September 22nd, and I think we're still having lots of fun here, right? Max is taking a snooze. I think he's paying attention, but you never know. Right now, he's just taking it easy. So we'll see what Max on the market says. Sometimes he goes off the couch, which means we're going to have maybe a little sell-off. Then he comes back and jumps back on the couch, and maybe that means the market's okay. So we'll keep an eye on him. He's just kind of Max is just another technical indicator. I guess we need all the help we can get with this kind of wild market. But the reality, it hasn't really been. It's been wild to the upside. It's been wild to the upside since we made a low on April 8th, a few days after Liberation Day. We had a couple of days of a couple of annihilation days, and here we are with the market basically at an all-time record high, which kind of is the topic of the day here. Is the Fed's policy too restrictive? Well, maybe what we should do is ask Mr. Market. So let's look at some charts and see what Mr. Market has to say about the restrictiveness of Fed policy. Well, let's see. We got the S&P 500 at an all-time record high. It's due for a little bit of pullback, I would think. It's way above its 200-day moving average and quite a bit above its 50-day moving average. But the power of this market has been awesome. I mean, it really started on April. We made a low on April 8th. So it really started on April 9th when the market, I think, was up. The S&P, I think, was up like 10%. The NASDAQ might have been up more than that, but just a powerful amount of net buying going on in the market. And we really haven't looked back since then. Once the market concluded that the tariff issue was not an earnings killer, wasn't going to cause a recession, and the market seemed to figure out early on that the tariffs might not even cut into profit margins. And so far, when you look at the macro data, there's really no evidence in the macro data for the S&P 500 that profit margins have been affected. Quite the opposite. The forward profit margin is at an all-time record high. So that's a bit of a puzzle, right? Because you would think that tariffs, if they are going to bring in $300 to $500 billion, well, corporate profits, all told, are about corporate profit tax receipts, I should say, corporate profit tax receipts that the Treasury gets, I think, are about $450 to $500 billion. That's kind of the neighborhood that's in. And here, assuming the current circumstances hold with tariffs, they're on track over a 12-month period to bring in something like, I don't know, 350, 400, even $500 billion of tariffs. Of course, there's a lot of uncertainty about that because the Supreme Court's supposed to weigh in on whether these tariffs are even constitutional. And I don't know, I'm sort of a Madisonian constitutionalist. And from my amateur reading of the Constitution, it doesn't look like the administration has this kind of power to impose tariffs. I mean, if you're running any sort of business, to have the government suddenly change the rules like this is pretty traumatic, and not the way it's supposed to work, in my humble opinion. But look, the other side of the coin is if the administration is able to finagle it and come up with some alternative ways to do the same thing with other sorts of legislative executive powers and still raise $400 to $500 billion. I think that's really their goal here, is to help reduce the deficit. That's why the president wants the Fed funds rate down to 1% as soon as possible. That would certainly help to reduce interest costs. It's all about the deficit, and of course 1% would be very stimulative to the economy and would help to offset the effective tax impact of tariffs. Doesn't mean that if they raise $500 billion in tariffs, that's all being paid for. I mean, corporations, American companies that are the importers anyways, they're the ones writing the check, but they could offset it by raising their prices, They may get some discounts from their exporters. But any way you look at it, tariffs are a tax, and no wonder the administration would like the Fed to lower interest rates as quickly as possible, as low as possible, to offset that on a stimulative basis to reduce the interest payments. And of course, the focus is all about fiscal policy in that regard. But meanwhile, none of the fine details of all these arguments seem to matter very much to the market. I had a call from a Bloomberg reporter this morning asking me about what's driving the market and why analysts, strategists have been kind of chasing it back up. I mean, my one regret this year is we were at 7,000 on the S&P 500 by year end. I don't know if it's a regret. I mean, I did what I thought was right. It seemed to me that the tariffs would have some impact on earnings and slowing down the economy. But nope, that wasn't the case. And so I went back to the idea that this economy once again is proving to be remarkably resilient. We had the virus, the pandemic. We had the lockdowns of the pandemic. We had the supply side disruptions of supply chains. We had that surge in inflation. Then we had a surge in tightening of monetary policy. Then we had tariffs. And guess what? Atlanta Fed is currently tracking real GDP for the third quarter at 3.3%, which is exactly the same as it actually did in the second quarter, 3.3%. So it's from a GDP perspective, everything looks just absolutely hunky-dory. And that, again, is, what's the Fed getting all excited about? Stock market all-time record high, real GDP all-time record high, growing fast. Well, obviously the dual mandate isn't real GDP. It's inflation and it's the labor market. And so they're kind of bent out of shape about the weakness in the labor markets. But that weakness, again, I think to a large extent has to be related to supply side issues that we've discussed before. There's a shortage of labor because the foreign-born population just since March through August is down 1.5 million, and something a little less than that is the decline in the labor force. From that perspective, whatever foreign-born labor that's here that doesn't have documentation, they're not going to get hired, given the way the administration has been deporting people, certainly very publicly. And so there is a supply issue. The supply issue, I think, has been exacerbated by AI. Not that I think that companies aren't still interested in hiring workers, but right now they're spending some money trying to figure out how AI might augment their current workers, make them more productive, or replace some workers. So I think there is, in some companies, probably a hiring freeze, or maybe you hire to replace workers that might have left. Right now, it's not as though nobody's hiring. There's this misconception that nobody's hiring. Hirings are actually around 5 million per month. 5 million per month. That's not an annual rate. That's hirings. And the separations are running exactly the same. So one way or another, people are leaving jobs, and you got to replace them, I suppose. But net, we're not seeing hirings exceeding separations, which is kind of a more factual view of what's going on in the labor market. But it's not at all clear to me that the Fed can do much about this in terms of lowering interest rates. Lowering interest rates, presumably, yes, could stimulate demand for goods and services. And if you're stimulating demand for goods and services, that would give you more real GDP. But what if you got labor constraint? Well, you better have productivity, because if you don't, you could have some more wage inflation. You could have some more price inflation. And so that's the conundrum that the Fed faces. They know all this. But I think under the pressure of the administration's political demands for lower interest rates, combined with the labor market indicators, which I think shook them up a bit, they decided to cut the Fed funds rate by 25 basis points. I haven't raised my probability of a melt up. It doesn't feel like the markets responded to the 25 basis points with a melt up. But then again, it did anticipate this for about a month, and we have been making new record highs. So there's Fed policy. Is the Fed policy restrictive? S&P 500 says not so much. NASDAQ says, nope, not at all. No problem whatsoever. We're on an AI high, and that's going to keep going. So who cares about the Fed? And if they give us 25 basis points, that's great. If we can get a Fed put when we don't really need a Fed put, all the better. Keeps the valuation multiples elevated. Might even justify the multiples going higher. Russell 2000 made a new high last week. It's kind of consolidating around that level to see whether it wants to go higher. I've been pointing out that the problem with the mid caps. I'm looking at the S&P 400 mid caps and the S&P 600 small caps, and I've been kind of scratching my head saying, why are these stock indexes performing so poorly? Why is the valuation multiple so low? And the answer has been that forward earnings for both of them have been kind of in a coma. They've been flatlining since 2022. And so clearly, meanwhile, the S&P 500 forward earnings has had some volatility, but it's basically been going to all-time record highs of late. We may be about to do that with the mid caps, but the small caps still have ways to go. But the good news, both of those seem to be hooking up a little bit. They seem to be wanting to show some signs of life, and maybe it's the one interest rate cut that did it. Maybe it's the small caps are learning how to live with some of the volatility coming from policy from Washington. But even the NFIB survey of small business owners has turned more optimistic. So again, if we look at the major stock market indexes, if we go back to April 8th, which was the low in the correction that occurred before there, and see what's going on, we can see that Magnificent Seven remain magnificent. The NASDAQ, not as magnificent, but pretty close. The NASDAQ 100, magnificent. Russell, doing better. S&P 500, doing well. And the S&P 500 equal weighted index is doing half as well as the Magnificent Seven. But I would say that, excluding the Magnificent Seven, the S&P 493, I call them the impressive S&P 493. If it wasn't for the, it's like being in a chemistry class in high school and being pretty good at what you're doing, but there's a couple of rocket scientists that just keep acing everything, and you keep getting B's and they keep getting A's, and B's is perfectly good. And there's a lot of these stocks other than the Magnificent Seven that have had bull markets. They just haven't been as impressive. But nevertheless, I'm going to call them the impressive 493. They've been unimpressive until now because I think that some of the magic that the Magnificent Seven have enjoyed will trickle down through more productivity for the broad economy. Meanwhile, it's too early to say that my warnings have gone unheeded. But back here when the markets, this is the 2-year and the 10-year versus the federal funds rate. And back here when the market started to anticipate that the federal funds rate would be cut, you could see that the 2-year and the 10-year yield went down. And I argued that if the Fed actually did lower rates, that you might get an adverse reaction from the bond market, bond vigilantes. And sure enough, they cut by 100 basis points and we went up 100 basis points, basically reversing all this expectations of the Fed easing. And here the Fed funds rate's been stuck all year. And now, last week they cut it by 25 basis points. And maybe, once again, we're getting an adverse reaction in the bond market. Maybe clearly the bond market already discounted this cut, but now we'll see what happens next. Well, we could have a PCED inflation number that's going to be 3% on a year-over-year basis. That's coming up. That's at the end of the month. That's not terrible, but it's the same as basically we had 2.9% the month before. And so I think that the tariffs have had an impact on inflation, not raising inflation, but keeping inflation from coming down is kind of the way I'm looking at it. So we maybe would have been down to 2% by now if it hadn't been for the tariffs. With the tariffs, we seem to be stuck at 3%. But it's not all tariffs. I mean, the tariffs have clearly pushed up durable goods inflation from having a minus sign of about 1% to a plus sign of 1%. But the other part of it is that the services inflation rates seem to be stalling out higher than they were pre-pandemic. So we still have an inflation issue. So I'm going to stick with the idea that the bond yield is kind of sort of where it should be. I had been talking to 4.25 to 4.75% for this year. Still sticking with that, even though we're slightly below that right now. And then next year I'm going to widen the range up a little bit to 4 to 5%. That'll give me some leeway here. But I don't think we're going to go above 5% because Scott Bessent would call up Janet Yellen and ask her to remind him what she did back in 2023. Well, he knows what she did in 2023. She told the bond vigilantes, if you don't like my bonds, I won't issue any additional ones. I mean, the pace of issuance will remain the same. And because I do need more money, I'll get that in the bill market. And so what's hanging over the bears in the bond market, what's keeping the bond vigilantes at bay is the potential for Bessent to say, okay, we're going to finance everything in the treasury bill market. And, he's rooting for that. He's been kind of also hinting that, by the way, he's a big fan of stablecoin, which was authorized by the Genius Act. Stablecoin, I'm told, is not allowed to pay interest, but still it has to be backed up by a solid liquid asset, and the Treasury bill clearly is one of the candidates for backing up stablecoins. So let's see how popular stablecoins become. I mean, the advantage of them is they're kind of like Venmo. You have instantaneous transactions, settlement, and all that. But meanwhile, the bond vigilantes still have to be concerned about the deficit. And here's the concern, and that is, what if the Supreme Court does rule that the administration doesn't have the constitutional authority to do what they've been doing with tariffs? And here, as you can see, the customs duties on a 12-month sum basis are $179.6 billion. If we just take an annualized monthly rate, we're getting over $350 billion. And clearly Trump loves this. He loves tariffs, and one of the reasons he loves tariffs is because it does bring in revenues. So let's talk about the dollar now. So we talked about the stock market. We're talking about 6,800 by year end, 7,700 by the end of next year, 10,000 or more by 2029, all consistent with our roaring 2020 scenario. Where we have been surprised of late is we've been very bullish on earnings, but they're turning out to be even better than we thought. And no signs of profit margins are getting squeezed. We thought that analysts would be, at the end of the year, targeting $300 a share for the S&P 500. Well, currently they've raised that to $304 a share, and there's still enough time here for that number to be $305 to $310 a share. We thought $300 a share, and again, that looked awfully bullish when we started talking about that at the beginning of the year. But the corporate America, God bless them, have demonstrated their resilience and their ability to get through all of this turmoil created by Washington. Meanwhile, with regards to the dollar, we're kind of hanging on by our fingernails here to this chart. We're down 10% on the DXY. The DXY is something like 52 or 57%. I forget, but it's something in that just north of 50% is the euro. So for all practical purposes, we're looking at DXY as being basically the euro. We can see that right here. Here's the trade weighted. This is not a trade weighted dollar. It's a fixed weight index, a dollar index. It's got the yen and I think the Swissies in there. Anyways, it's clearly highly correlated with with the euro. And so, tell me exactly what's so exciting about the euro? Well, by the way, on a trade weighted basis, which the Fed calculates, we're down 7.5%, so not quite as bad as the 10%. Um, but again, when I look at the capital flows data, which is a little bit lagged, we have July just came out last week. It certainly looks like foreigners over the past 12 months have been impressive buyers of our capital instruments, equities and bonds and CDs and bills and all that. When we look at bonds versus stocks purchased by foreigners, you can see basically over $600 billion. The month before was a record high, but it's in record high territory, 600 billion in the past 12 months. And look at the history of this thing. I mean, all-time record high, tremendous amount of buying. I have pointed out before that foreigners can be contrary indicators. When they come in and buy massively, that's a warning signal. So put that on the list of bullish for equities and dangerous for equities. And here's the U.S. bonds, corporates, mortgages, treasuries that have been purchased over the past 12 months. Not as high as it was back here, but I don't see any signs here that foreigners are bailing out of the U.S. equity and bond market and moving it all into Europe. And again, when Europe's got its issues, Germany is getting manufacturing is, I don't know if it's hollowed out yet, but it's facing enormous competition from Chinese manufacturers, particularly in the auto industry. This is the 10-year bond yield for Italy and France, and France used to run at a lower bond yield because Italy was deemed to be a riskier security, but now France is just as risky as Italy. And as we know, there's political and turmoil, and there's a potential debt crisis over there because the French just keep rioting in the streets whenever there's any suggestion whatsoever that they extend the age for retirement or whittle back somewhat on social welfare programs. They don't like that, and so the deficits remain very large. And so France may very well be a canary in the coal mine for other countries. UK is another canary, and Japan is another canary. So maybe what's happening here is suddenly the U.S. doesn't look like such a bad place to stay or to hide. So maybe that's why our bond yields have actually declined somewhat in the face of rising bond yields in France and the UK and Japan. But anyways, our gold recommendation continues to work quite well. When it crossed above 2,000 last year into a new record high, we said, this may be the beginning of a bull market. When it crossed above 3,000 at the beginning of this year, we started saying it is a bull market, and we think it could go to 4,000 by the end of the year, which seemed pretty delusional. But here we are at 3,700. And then if we get to 4,000, we'll start talking about 5,000. Obviously, we're already starting to talk about it. And they say that Bitcoin is digital gold. Maybe gold is physical Bitcoin. But whatever, our underlying thesis has been pretty straightforward. Central banks of countries that don't like us, like Russia, China, Venezuela, Iran, these countries' central banks have been buying more gold and trying to cut back on their dollar reserves, their fiat reserves from the U.S., maybe even from Europe, because they don't want to see their reserves frozen the way the U.S. and Europe froze Russia's assets. And now the Europeans are talking about using that $300 billion to help Ukraine. So let's talk about the Fed real quickly here. One of the topics that we covered is what is the neutral interest rate? And just to be clear, I think the neutral interest rate is a bunch of BS. I mean, the Fed keeps talking about the long-run federal funds rate, and they say that it should be 3%. That's this number over here, the longer run. This is from the dot plot. But look at the range of expectations there's quite a range here. It's not like everybody agrees that it's 3%, but if the average is 3%, that must be the long run neutral rate. And so if they lowered the Fed funds rate by 25 basis to 4%, uh, Powell can say, well, we still believe that our policy is restrictive because it's 100 basis points above the neutral rate. But it's such a cockamamie idea to have an overnight interest rate viewed as some sort of neutral rate at which we achieve nirvana of maximum employment and stable prices, the so-called dual mandate. By the way, maybe we're there at 4%. I think we are. We aren't quite at 2% on the inflation rate, so we need to be somewhat restrictive. And I think 4% makes more sense than getting down to 3% in terms of bringing inflation down. We'll skip these here for a second. For now, you can look at it on your own. But this is let me see where I want to go. I want to go here. This is the inflation expectations with the expectations for what they're going to do with the Fed funds rate. And you can see they think it's going to be 3.6% this year, then 3.4. So in 2027, they think they'll finally get inflation. Let's see. Sorry, that's the Fed funds rate. They think they'll finally get to their neutral rate. So it's going to take them until 2027 to get to neutral. But meanwhile, they think that's okay because these are high enough relative to the Fed funds rate that that's going to bring inflation down. Good luck with that. Anyways, I think we are in nirvana now. This is a chart showing the unemployment rate minus 4%. I think it's reasonable to say 4% is nirvana for the unemployment rate. And this is the CPI inflation rate minus the 2% central bank nirvana. And you can see that we've been at nirvana a few times. We don't stay there very long, which kind of raises the question whether the neutral rate makes any sense also from the point of view of whether it's stable. I mean, Fed officials have said that they can't measure it. They can only estimate it with their econometric models, which, we know what that's worth. And they have also said that it may not be stable. And yet, somehow or other, they think, over the next couple of years, getting it down to 3% gets it down to neutral. Anyways, it doesn't matter what I think. What matters is what they think. And I think what matters in terms of what I think is if I'm right and the real rate is more like 4% than 3%, or maybe it was more like 4.5%, then having the Fed lower rates is actually stimulative. And if you can't stimulate the labor market because of structural problems, then maybe you'll be lucky and get productivity. But on a short-term basis, you might also get more inflation out of it. And you will certainly you certainly increase the potential for a melt-up in the stock market, which then creates a meltdown. And we don't want to go there. So let me answer some of the questions here. Let's see, Joe, are you concerned about the recent demand fall off of cardboard box materials? Haven't really paid much attention to it, Joe, but I'll look at it. Yeah, we do try to look at a lot of these cyclical indicators. I don't know, more and more of us are buying more and more from Amazon, and they've got cardboard boxes, but they've also got more plastic bags and things like that. So I don't know what to make of it. But you could certainly, historically, cardboard boxes have been a useful indicator of the goods economy. And so, by the way, has the ISM Manufacturing Purchasing Managers Index, but it's actually been useless over the past few years because if you take a chart of the ISM Manufacturing PMI versus the year-over-year percent change in real GDP for goods, in the past they were very, very closely, they tracked each other very closely. Now we've seen that the ISM manufacturing PMI has been suggesting much weaker growth in GDP for goods than we're actually getting. We're getting better growth. William, have we seen the full impact of the tariffs? Good question. I'm not sure that we have. I think there's still likely to be some impact on durable goods inflation. And then I guess there's I mean, there's all these other, in addition to the reciprocal tariffs, there's the tariffs on individual countries. There's steel and aluminum, so I guess we'll see how that plays. And now there's the visa issue that the administration is trying to restrict, if not stop, the immigration, the legal immigration of professional people. I don't think it's a great idea. I don't think there's um, a surplus of professional applicants in the United States, Americans that are looking for those kind of jobs. The unemployment rate for adults is below 4% in America. So it's not as though we have a lot of people to replace these talented scientists and doctors and all that. And you know, Lutnick said that this should give an incentive to American companies to train American workers. Well, you really can't train kids coming out of school with degrees in business and management and communications, which is kind of the mismatch problem we have in the labor market. You can't take those kids and make doctors of them by having some hospital bring them in. So I think it's a really bad idea. And if anything, we want to bring these people in and then give them citizenship. So, and that's my 2 cents on the matter. Can you repeat your outlook if the Supreme Court rules the administration's tariffs as constitutional? Do you think this is likely? Well, I'm an amateur on the. When people ask me if I'm a Republican or a Democrat, I you typically answer that I'm a Madisonian constitutionalist. I really think the Constitution is a really cool document, and I think it's remarkably relevant today. Um, and that being the case, I don't get the sense that it's a slam dunk that the Supreme Court is going to say, yeah, the administration did right. I think there's a real chance here that they'll say uh, it wasn't, they don't have the constitutional power to do what they're doing, in which case every importer that's had to pay duties is going to write a letter to the Treasury, say, we'd like, how do we apply for a refund? That could be quite a messy situation. And there are alternative legislations that do give the administration some power over tariffs, but they're not as clean cut as what they've been relying on. Willem, in 2014, I called gold shiny Bitcoin. Well, if you, Willem, if you had the patience, that was a good time as any to buy them, especially given what we're seeing going on with gold now. I have never in the past recommended gold. It's just not my thing. I like something I can. It doesn't have income. It doesn't have interest. I need something to discount. But under the circumstances, gold looks pretty good as a hedge against all kinds of things. But I simply did it on a very technical reality, and that is some central bank, and relatively important central banks, maybe Venezuela is important, but China and Russia and other central banks, if they're not going to take dollars and convert them to gold, that's a pretty good underlying central bank put for the gold market. Well, let's end on that shiny note. Thank you, everybody. Actually, I'm going to be going off to California next week, Monday. So maybe I'll pre-tape some of my thoughts for you over the weekend, and we'll do it that way. But I'll keep you posted on where I'm going to go on that. So thank you all. Have a great week.